Welcome to King & Shapton's second quarter fund manager report. My name's Harry Thompson and I'm a portfolio manager at King & Shapton. Today's slides will cover the quarter to the end of June 2021. The fund manager report is also available in text format via the website, and performance data is already available via the fact sheets for model portfolio clients and quarterly valuations for full bespoke. We reflect back on another positive quarter. Equity markets have returned between 10 and 13% so far in 2021, and between 5.5% and 7.7% in the last quarter. These gains are at a more sedate pace than the volatility of 2020, and the returns for fixed income and infrastructure have been more subdued. Towards the end of the last quarter, we noticed a shift back away from the reflation trade that had dominated 2021, i.e. favouring oil and consumption-based investments, now back towards a more growth-focused market, which in turn enabled ESG and impact investments to recoup some of the relative underperformance in 2021. The reflation trade fixes the focus of equity markets firmly towards the current macroeconomic recovery and less on how the post-pandemic economy will look, which remains the focus of growth-orientated investments. This leads the market to vacillate between the two types. Whilst the virus is far from gone, vaccination programs have taken effect in the UK, US and some other G7 countries. And in some regions, restrictions are being slowly lifted. However, the new Delta variant has added to the uncertainty. To date, the market recovery expectations have been met and even exceeded. PMI data has been strong, with global PMI data well above the 50 level of expansion, as seen by the graph on the left. The recovery has been notably strong in the US, where nominal GDP has risen above pre-pandemic levels, as seen by the graph on the right. The focus will now shift towards company reporting, and we'll be focusing on the question of whether we have reached peak positivity, and how other nations outside of the UK will move forward. The good news concerning the recovery so far comes with a huge caveat that the market is very cognizant that it's supported by very cheap and abundant money from central banks, something that is not sustainable. How, when, and at what pace this all changes are the key questions for markets right now, and there are a number of views as to the pace and the implications of these changes. In addition to this concern, the other big unknown is when governments will lift many of the support mechanisms they have put in place. When these life support systems are turned off, we have no doubt some businesses will fail. This failure may not be on the apocalyptic scale implied by some, but some sectors will not recover fully. On the flip side of this, the crisis has caused an acceleration in innovative ideas and a desire to build back better, which will in no doubt benefit a number of sectors. We have seen a rise in inflation, and to a large extent this is wanted and welcomed by central banks after years of low inflation and low growth. There are some concerns in the market that inflation may be harder to control. These concerns are largely driven by history, and we see the recent inflation issues as more cost push than demand pull driven, with issues such as the chip shortage and a shortage in global shipping adding pressure to the global supply chains. When it comes to inflation, we do not see it as the prominent risk for the market, as we believe it to be transitory. We are more concerned about the future demand for fixed income investments at a time of increased supply. Firstly, for us, debt only remains attractive for the ethical nature of the underlying investment, such as immunisation bonds with IFIM, who provide funding for life-saving vaccines across the globe, or microfinance, providing poverty alleviation to many underserved individuals and SMEs. Secondly, because we want to reduce risk within portfolios. Here we favour floating rate notes, where there is no interest rate risk. However, the cost of debt has impacted the yield-based infrastructure investments that form a core part of portfolios. These investments provide exposure to areas such as renewable energy, energy efficiency, or social buildings such as libraries or schools. With regards to property, we've been pleased with the returns from social, affordable and homeless housing. We continue to avoid office and retail as we feel there is some pain to come, as rent arrears and failed retailers will need to be addressed. Renewable energy was one of the poster children from last year's surge in ESG and impact investing. However, renewable energy yield companies have been a victim of their own success, and there are concerns over falling electricity prices, both spot for purchase today and longer-term prices. We see this as a short-term issue. Further UK nuclear capacity will go offline soon, and battery parks and storage will mitigate some of the variability of renewable energy. We added an investment that owns and operates energy storage plants to the portfolios in the last quarter. The sector is still lagging the market this year, but not as much as it was in March, and we see the recovery potentially speeding up as investors and customers demand more and faster climate action. You could argue the net zero targets are not being priced into some of the sales growth expectations, with the International Energy Agency's scenario for renewable energy growth pointing to a 13% compound annual growth rate in the gigawatts required between now and 2030. Our focus remains on the global economy in 2 to 3 years' time rather than the near-term reflation trade. We expect the focus to shift from crisis recovery to how the colossal stimulus measures will be withdrawn. It is a move that is widely anticipated, so much will depend on how expectations are managed. The path of the virus will remain front and centre, particularly in those countries such as the UK, who are going down the route of learning to live with it rather than to keep restrictions in place. Where question marks over whether we have reached peak positivity coincides with the latest quarterly reporting season, and coupled with concerns over the virus, we expect a lot of noise and maybe some volatility along the way, especially as we see a tilt towards economies and sectors that are focused on structural growth trends that align with the Build Back Better mantra. From an environmental perspective, we see further acceleration ahead of the COP26 in Glasgow later this year, and scrutiny of pledges and performance in this sector is increasing. Notably, pressure is rising on offenders, not just focusing on environmental credentials, but social behaviour and governance as well. The paradox of these changes, however, is an increase in greenwash and data abuse as it begins to encompass more of the market. Thank you for listening to the second quarter Fund Manager Report. If you have any questions, please contact us by the details provided.